Hello everyone, welcome to Blue Dragon Actuarial. I am recording this video for two reasons. First of all, I need to release a video for the interview, which should be released on Saturday, and right now the time is 12:40 Friday, so it should be Saturday. It is counted as Saturday only, and also I need to release the video of discount rate part three. But when I was kind of thinking about the discount rate part three, which should be how the discount rate and the investment income interplay in embedded value calculation, that will be the final part for discount rate. So if you have not seen the first two part, you will not understand about the part three that I am talking about now. So you need to see the first two part. So please go to my channel and search for curious case of discount rate part one and part two. Discount rate is indeed very curious, that's why that name. Now, when I thought that to explain that concept, I have to explain some other concept, right? So this concept is also one of the favorite interview question that I have. So I thought that why not combine these two thing? Because if I release the part three of discount rate, I need to explain this first, and also this is one of my interview question. So why not combine that? And this week, let us release one small video only, which will kind of play for play the both the part also for the discounted as for the the interview series that that is ongoing currently. So this is what happens when this question is, as you have seen in the thumbnail, what happens when a person dies in life insurance, right? And this is something that is very, I can say that most of the people has no clear idea about what happens, right? So what happens when a person dies? The reserve would be released. Why the reserve would be released? Because the policy would not be enforced, right? You only keep reserve for enforced policies. If the person dies, the reserve would be released. Now herein there is a second point that I would like to address, which is it would not happen the same way for health policy. Why? Because in health policy, the person would become disabled, right? The person would not go off the books. So when in life insurance, the person dies, the policy goes off the books, right? You have to make the payment and the policy goes off the books. But in health policy, what would happen is when the person dies, when the person becomes disabled, not dies, right? So then you need to pay the person till the time the person is alive, right? So that's why when the person dies, there will be a different reserve. We call that DLR, or disability life reserve. And when the person is on like correct shape, or when the person is doing well, then we have another type of reserve. We call that ALR, right? Or active life reserve. And then DLR will be the disabled life reserve. So that is not something that I want to go too much into detail of. But just remember that whenever a policy is enforced, we need to keep the reserve, right? But because a person dies, the reserve would be released. So that would be when a reserve is released. Reserve is a liability. When that is released, it is a positive cash flow, right? It is gain for the company. So this is a positive cash flow, right? This is a positive cash flow. Now, if we come here, also we need to pay the claim, right? Because the person has died. So that would be a negative cash flow, right? So this would be a negative cash flow. So the difference between this positive cash flow and the negative cash flow will decide whether there will be a profit or loss when the person dies. So what happens when the person dies early on? If the person dies early on, there might be a chance that your reserve would not be that big enough, right? Your reserve might be very small because the reserve has not been accumulated, it has not accumulated the investment income, etc., etc. Reserve might be very small. In fact, for best estimate basis, the reserve might even be negative. It may not be positive as well. So in that case, there is a high chance that you will have loss. However, if the death happens at the later stage, then your reserve would be sufficiently big, then the death payment might be lower, and that's why there might be a profit even when the person dies. So that's why companies kind of are afraid of the early claims, especially for term assurance policies. Companies are afraid of the early claim because their reserve is anyway, for term assurance policy, the reserve is very small, even at a later stage. So if early death happens, then the reserve would be very small and there will be high chance of loss, right? So I think whenever I have asked this question, I don't remember anyone give a correct answer. So I think now it would be clear that it is the interplay of this concept. Release of reserve, which is a positive cash flow because the policy is not enforced, and payment of death benefit, which is the negative cash flow because you have to kind of pay the claim, and the interplay between this, the plus and minus of this would create the profit or loss. And obviously it depends on the duration, because reserve calculation depends on duration and reserve size depends on duration. However, what I have seen is most of the people give this answer, which is related to pooling of risk. Now, obviously, we know that life insurance is something where, or any insurance, there is a pooling of risk, right? We don't expect every policyholder die at the same time. If that happens, the insurance company would go bankrupt, no matter how much reserve that company keeps. But that does not mean that the insurance company is not keeping reserve for each policy. So, insurance company has a mortality rate, right? And because of that mortality rate, the insurance company believes that maybe if the person has 100 policies, out of that 100 policies, 70 would die, right? For a particular block, the mortality rate can vary. Also, the mortality rate varies depending on the age. So, suppose for a particular block, there is only people are only aged similar, let's say 20 age. 20 is the age for that block. Obviously, there would be a mortality which would be applied for all the policies, and the expectation would be that not all of these policies would go off the books or would become a claim at the same time, right? If that happens, any company would go bankrupt, no matter how much reserve they keep. And that's why we calculate the mathematical reserve based on the assumptions, right? Mortality assumption, lapse assumption, expense assumption, etc., etc. All those contribute to the reserves. So pooling of risk give you don't contribute to that, you know, don't to contribute to having a capital which you can be used which can be used to pay the claims. Pooling of reserve is a separate thing altogether. Obviously, pooling of risk help you to manage risk, or helps your risk to be lowered. But the insurance company is keeping reserve for each and every policies. They don't depend on pooling of risk in that sense, or in that part, that if uh, some other policies premium would be used to pay the claims. So because my usual question is, what happens if the person dies early? Because you have like this, when I ask this question, what happens when a person dies, and usually I don't get the correct answer. And whatever answer I get, usually I try to go much deeper. So if I ask what would happen if the, and normally the answer would be they would use the other policies premium to kind of pay for the claims if the reserve is not sufficient, right? So that is not the case. If the reserve is not sufficient, then that policy would incur a loss, right? You, and obviously in essence, you are like when you have to pay the claim, right? When you are paying the claim, then that depends on how you are kind of paying the claim. Maybe in this case, obviously, some other policy might be subsidizing that. So in that way, pooling of risk is kind of helping you, because your reserve is not sufficient. So there is a risk, right? And that risk is kind of catered to by the pooling of risk factor. But it does not mean that the policy company is not keeping reserve for that policy. Company is keeping reserve for that policy, and when that reserve is not sufficient, then then there will be obviously that you will expect the reserve to be sufficient. There will be margins, and then even if the prudent reserve is not sufficient, then might be then the pooling of risk would come into picture. Also, the company keeps capital, which the company can be using to pay for unforeseen circumstances. By unforeseen circumstances, by means something like COVID, right? So I believe that this portion is now clear. What happens when a person dies? And pooling of risk is not directly related to it. The company would first try to pay through the reserve, and the company would hope and pray that the reserve would be sufficient enough. And if the reserve is not sufficient enough, then obviously the company had to pay. So either the shareholder has to pay for that, or if there is sufficient money, assuming that other person have not died, and there is a block asset allocated to that block, right? So then the company would use that asset to pay the claims, right? So that's why when the investment happens, there would be some portion that would be kept in cash, like maybe in saving account. By cash, I don't mean the company would be keeping cash in their, in some locker. The cash would be kept in bank, and that would be used to pay for the short term claims or the expenses, etc. So I hope that this myth is clear, that pooling of risk is used to pay for the claims when the claims are not sufficient. It's only a second order. There is only a second order impact on pooling of risk. So I hope after a long time I am keeping the video very small. So I'm happy for that. I hope you are enjoying this video. Happy holidays, everyone. I am in my hometown for the Durga Puja, although I don't believe in any gods or goddess or any religion. But I come home because my family would be here, my brother would be here, my cousins would be here, my friends would be here. So it's a great gathering and get together. So I'm enjoying that. I will be releasing my discount rate part 3 video next week. But for this week, there will be no release, no further releases because I'm kind of busy. And yeah, I'm enjoying my time, and hopefully you are also enjoying your time. Thanks for watching, and see you in future videos.